Hello everyone. In previous videos, we were covering the research analyst series of NISM. So in previous video, we were covering the chapter 2, 2.2.6. Now in this video, we were covering next term, that is hybrid or structured products. So let's start now. So the first point is preference shares. So preference shares, as their name indicates, are a special kind of equity shares which have preference over common or ordinary equity shares at the time of dividend and at the time of repayment of capital in the event of winding up of the company. They have some features of equity and some features of debt instruments. Preference shares resemble equity, as preference shareholders are called shareholders of the company, not creditors. Payment to them is termed as dividend, and the same is paid from the profit after tax. And dividend payment is not an obligation unlike interest. However, unlike common equity shares, preference shares do not carry voting rights or a right over the residual assets of the company in case of winding up. So preference shares resemble debt instruments because they offer a predetermined rate of dividend, and this dividend is payable before any dividend is paid on common equity. Further, in case of winding up of the company, preference shareholders get paid before common equity holders. In other words, these shareholders have preference over the common equity holders at the time of distribution of both earnings and assets. There are variety of preference shares. Cumulative unpaid dividend is carried forward, and non-cumulative, that is unpaid dividend lapses, convertible partly or fully, etc. So next term we have is convertible debenture and bonds. So convertible debentures are debt instruments that can be converted into equity shares of the company at a future date. This security also has features of both debt and equity. It pays periodic coupon or interest just like any other debt instrument till conversion. And at a predefined time, this debt instrument may get converted into equity shares. These debentures may be of different kinds. There are three types of debentures. First one is FCD, that is fully convertible debentures, where the entire face value of the debenture is converted into equity shares. Second one is PCD, that is partly convertible debentures, where a portion of the debenture is converted into equity. The non-convertible portion continues to remain as debenture, earns interest income, and gets repaid on redemption. Third one we have is optionally convertible debentures, that is OCDs. So OCDs are convertible into equity shares at the discretion of the debenture holders, who may choose to convert them into equity or continue to hold the instrument as debt, depending on their desire and the terms of conversion. The issuer specifies the details of the conversion at the time of making the issue itself. These will generally include uh, date on which or before which the conversion may be made, ratio of conversion, that is the number of shares that the investor will be eligible to get for each debenture, price at which the shares will be allotted to the investor on conversion. Usually this is at a discount to the market price. Proportion of the debenture that will be converted into equity shares in case of partially convertible debentures. The advantage to the issuer of convertible debenture lies in the fact that convertible debentures usually have a lower coupon rate than pure debt instruments. This is because the yield to the investor in such debenture is not from the coupon alone, but also the possibility of capital appreciation in the investment once the debenture are converted into equity shares. Moreover, the issuer does not have to repay the debt on maturity since shares are issued in lieu of repayment. The disadvantage this is that stakes of the existing stakeholders get diluted when fresh shares are issued on conversion. As more shareholders come in, the proportionate holding of existing shareholders fall. The investors in a convertible debenture have the advantage of equity and debt features. They earn coupon income in the initial stage. usually when the company's project is in the nascent stage, and once the debenture is converted into shares, they may benefit from the appreciation in the value of the shares. The next term we have is Indian Depository Receipts, that is IDRs, and Global Depository Receipts, that is GDR, and American Depository Receipts, that is ADRs. So let's start this one. So depository receipts are financial instruments that represent shares of a foreign company. These depository receipts trade in the local market in which it is issued and are denominated in local currency. The process of issuing a depository receipt is as follows. A company or an investor delivers a specific quantity of equity shares to a bank. The bank places the security in its custodian account in the country where the company is domiciled. The bank then issues a certificate, that is depository receipt, against such shares to investors in the overseas market. If the issuing company is the one that delivers the securities and initiates the process, it is referred as sponsored depository receipts, and they can be listed in the exchange of the country in which the DRs are issued. So companies that want their DRs to be listed should apply for listing and should comply with all the listing requirements. On the other hand, if the shares are delivered by an investor, they are referred as unsponsored depository receipts. Typically, unsponsored DRs are not allowed to be traded in the stock exchanges. They can be traded only in OTC markets. They also have less regulatory requirements. DRs may feature two-way fungibility subject to regulatory provisions of the countries involved. This means that shares can be bought in the local market and converted into DRs to be traded in the foreign market. Similarly, the DRs can be bought and converted into the underlying shares which are traded on the domestic stock exchange. Indian companies are permitted to raise foreign currency resources in the form of issue of ordinary equity shares through depository receipts. Foreign companies are also allowed to raise equity capital from India through IDRs. So SEBI has laid down the guidelines of the to the following to be followed by companies for IDRs. These include the limit on the money raised by a company in India, 1 year lock-in on the conversion of IDRs into shares, the availability of IDRs to only resident Indian investors, etc. Several stock exchange around the world allow trading in depository receipts of a foreign company. These depository receipts can be specific to a country or it can be traded across multiple countries as in case of GDRs. So some of the country specific depository receipts include, so we will cover this part in our next video. So this was about the depository receipts of all countries. So that's it for now. Thank you.